So, good afternoon, everybody. It's my great pleasure to welcome you on this afternoon's webinar, which is about the important subject of Do Angels Make Money? I'm joined today by Oliver Woolley, who is CEO and indeed the author of this an amazing piece of research. So you're actually going to get it straight from source. And I'm very much looking forward to spending the next 45 minutes with you all and with Oliver to explore this amazing subject. Oliver.
Thank you very much, Dermot. And I'm thrilled to be here. Thank you so much for inviting me. I'm going to start sharing my screen. So I'm kind of hoping that people can see the screen. And if they don't, Renita, please let me know. I'm presuming you can. So I'm going to speak for 20 minutes about do angel investors actually make money? If the answer was no, then I wouldn't be doing what I'm doing. Thankfully, the answer is yes. And what we've done is a fair amount of research just to see, first of all, are people making money? How much money are they making? And also to try and increase the chances of more investors making more money through EIS. So I'm going to spend 15, 20 minutes going through the research findings, the track record. I'll pick up a couple of case studies, as well as some top tips. And just as a reminder on EIS and SEIS, since certainly that's what most of the investors are looking for in terms of getting tax efficient investing. We're thrilled to be working with stakeholders. So investors matching entrepreneurs with investors. We provide the platform and also the FCA regulation, and stakeholders is a introducer appointed rep of investors, and we are authorized and regulated by the Financial Conduct Authority. We've got a number of networks, incubators and accelerators on our platform, but I'm thrilled to say that honestly, stakeholders is by far the biggest and the most active. So we're delighted to be working with them. On the stakeholders platform, you'll see all the deals and all the deal flow, and all of these which are fundraising have been signed off by us as fair, clear, and not misleading to make sure we meet all FCA regulatory standards. So it's been my personal mission to actually try and get some real data from angel investors. And so we went out to our investors, but we also went out to a number of other people. We had a huge amount of help from other networks, as well as the UK Business Angel Association, Cambridge Angel Stakeholders, Angels Den, various others. And I must say these people at the bottom have been particularly helpful in helping us to get data. We asked people, individuals, who'd invested at least £250,000 in total in more than 5 companies over more than 10 years. So we got data on £66 million worth of investment into 1,500 companies. From that 66 million, 46 million had already been realized. And they estimated, we asked them, it's a bit difficult, so it's quite a protracted process, but we asked the angels to say, well, what do you estimate the remaining portfolio of winners and losers? And it's normally based upon their last funding round and whatever valuation was that at, which led to what the gain is at the moment, which is around 94 million. Interestingly, we looked at the 1,500 companies and found that 10% of them had exited and exited well. 22% had failed, and the rest of them are sort of somewhere in the middle, which is sort of roughly where what we thought we were going to be expecting to see. So this is a snapshot of the individual 43 people that we got responses from. There's an average IRR of about 13%, which excludes the benefits of tax. And most people were making a net gain from their investments. And we had a few outliers, people who were making a serious amount of money out of angel investing. And John Moulton, who's one of the biggest angel investors, says he made more money out of that than anything else it does. So we are actually going to continue this. So If you're one of these people who have invested more than 250 grand in more than 5 companies over more than 10 years, we'd be very pleased to hear from you. And we're looking to get further data. We're looking to get up to 75 angel investors. And then if you do submit it, we'll give you advanced view of the final report. And also we'll be sharing it with all the stakeholders bunch anyway. Just to say about our track record, so investors, we've been going for a while. We've got our own investor group, which sits on the platform, and have invested over 100 million into over 200 companies. And we have had 25 successes, 43 failures, and there's the percentage. There was some research done by the UK BAA a few years ago, which showed that actually the number of successes was around 9%, 3 out of 33 was the number they came up with. And over half of them were failures. So what we are doing collectively at Investors with people like stakeholders is trying to raise awareness and understanding and education of both the investor as well as the entrepreneur, so we can get better deals. And I genuinely think we're all getting better at this so that we can get better deals done. Here are 3 examples of absolute winners. Chargemaster, which is electrical vehicle charging points, originally raised money in 2008 at 4.5 million, and they made about 40 million for various investors when they exited to BP for 129 million. eBri was our first sort of unicorn, which was valued at $1 billion when Santander brought into them. Parking Eye, very fantastic business, very early in vehicle number plate recognition. There were 3 investors who put in 125 grand. When the company was bought by Capita for 50 million, they walked away with 13.2 million. So those are the ones that we're looking for. And this is actually just a breakdown of the Chargemaster. I'm not going to go through it, but it shows how the investors managed to make a realization of 42 million pounds. These slides are available from Nita afterwards, and you can have a closer look at how it happened. So we can ask, well, what does a good deal look like? And these are the top things that we look for. Valuation is a key. It's a key thing. It's making sure that the company is raising the right amount at the right price, or the right valuation, from the right people at the right time. So if you're a startup looking to raise, you should be looking to raise a modest amount, 150 grand to 500. What we don't like is startups who say they're looking to raise 2 million at a 5 million valuation. So we've got 2 guides. We've got a guide to raise, the guide to investing. We've also got a 70-odd page guide to raising finance, and one of the things it talks about is valuation. Full-time management team, independent board, which we like the idea with stakeholders, because we know there are a lot of very, very experienced execs and chairs and non-execs. And a lot of the early companies, startups, they don't have a board. But if they've got an email signature which says founder, CEO, chairman, president, it just makes us all a little bit nervous. And so what we like to get good deals done is for there to be a board, or for the founders or founder to look to get an independent board. We had a bit of a challenge with a recent company which has been massively successful, but the founder owns 55% of the shares, was doing very well. He decided to pay himself £1 million a year, which was great for him, but there was no protections for minority shareholders. And eventually things have managed to sort them out. But it's good to have an independent board to manage the corporate governance of the company. Looking for the potential of explosive growth, EIS, exit, understanding how and when the company is going to exit and make money, as well as a compelling story, actually making sure that the company is fully investment ready. And that's quite key, because we get a number of companies that approach us and they really they've got their fantastic deck, but they haven't really thought about it from the investor's perspective. So I'm just going to run through 15 very quick points. And by the way, if you have questions, please put them in the Q&A and we will deal with them afterwards, or put them into the chat and we can respond to them. So as I mentioned, we've got the guide to investing. If you're serious about angel investing, please, it's a good thing to read over the Christmas holidays to increase your chance of successfully making money out of angel investing. And for each company that goes up onto the platform, they have to complete what's called a key investment disclosure document, or KID. That means that as well as having the fantastic pitch video and business plan and various other things, this makes sure that there are full disclosures, and it will take a company a day or two to complete it. And there's a lot of things they've got to put in. But once the information is there, then it helps everyone to make quicker decisions and to find the right investor. Also within this, there's a deal rater tool, so the entrepreneur can see how well they're doing, and they come up with a score at the end with 100. And there's a flagging system whereby actually there's 20 different flags that will flag if certain things need to have a little bit of attention. So I'm going to go through these in the next 5 minutes. These are the top sort of 15 things that we look at, which are more hygienic matters once you've seen the business plan and met the team or not, and thought, actually, this is quite an exciting opportunity. Making sure that there has been any disclosures on legal proceedings. Again, we've seen companies come across who think, wow, that's really exciting. And as we say, it's really exciting, but then we groan and we find that there's something that isn't quite right. Corporate governance, I've always mentioned. IP, it's important that the IP is owned by the company. And we've had a situation whereby a company has been quite successful, and it's turned out that the IP was owned by 2 separate individuals who ended up falling out with each other. And actually, there was all sorts of problems with valuing the company as a result of that. Solvency. Now, as I said, I can get up to 5 business plans sent to me a day personally. And the number of companies we see which are actually technically insolvent. In other words, they've been trading for a while, and sadly, we saw this a lot in COVID. They were really, really struggling, and they thought, well, the answer to fill a massive hole in our balance sheet is to raise equity finance. And what really should happen, they should go through a process and then come back and raise money once they've sort of cleaned things out. But it's surprising the number of business plans floating out there, or you'll see them on unregulated platforms, which are actually technically insolvent. Looking at things like directors' loans, quite a lot of small early stage companies and startups will have directors' loans. Nothing wrong with them as long as their treatment is expressly stated, because technically you can put equity into a company, and if there's a director's loan, they could just use that equity to pay them back immediately, which no one wants. Tax status, EIS and SEIS, we want to make sure that that is done properly. And we have seen matters where a company has somehow managed to invalidate EIS by changing the articles or doing something different, or that the papers haven't been issued and produced and processed properly. So we make sure that every company has got a proper tax advisor, and you need to have a tax advisor, a lawyer or an accountant that's managing the EIS. Balance sheet needs to be signed off by someone who is a professionally qualified finance person with a professional accountancy qualification, and it isn't that it's just been signed off by the CEO who doesn't know much necessarily about signing off the balance sheet. There's a whole section on the importance of the balance sheet in the guide. We saw last week a company which had positive net assets of around £450,000. When we looked at the balance sheet, there was 1.6 million in intangible assets as goodwill. You took that out, the business was effectively a bust business. Cap table, quite obvious, it's understanding who owns what. Recent financial statements, further funding rounds, it's very useful to understand what those further funding rounds are and the timing and the amount and the pricing. And so we do get some companies that say, right, we want to raise £2 million. Actually, you might raise £2 million, but you're going to separate it in tranches, because the first £500,000 is probably going to be earlier at a different price or different valuation than the other £1.5 million. So it's having a sensible strategy for breaking down the funding round. So we look at what's called the fundraising spread, which is the minimum a company's looking to raise and the maximum. And if they say, well, the minimum is 50,000 and the maximum is £1 million, and that's all at the same price, that's not really going to be something that's very clever. So we tend to, the sweet spot is something where a company is looking to raise a minimum of 250 and a maximum of £500,000, or £500,000 to 1 million. So that sort of fundraising spread. The investment legals, we just want to make sure that they are done properly. We're not dealing with term sheets here, because a term sheet will come from a single fund or a family office or large investor. The company will be expected to make sure that their articles are up to date, that there is a subscription agreement. In other words, saying, well, if I do want to subscribe for shares, what is the share price? How many shares are issued and authorized? So actually understanding, making sure that the investment legals are done properly. Full disclosures to make sure there's no conflicts of interest. Again, we've seen companies where, fantastic company, they've got a main supplier or customer that actually is owned by the same person that you're not investing in, or perhaps there's a husband and wife team or children involved. It's part of the things that we make sure there are full disclosures about of any family relationships. It's not necessarily a bad thing. We just want to know what those relationships are so we can make better decisions. Directors' salaries and terms, we want to make sure that the founders have signed a contract of employment with the company, and it clarifies all the terms. If things go badly wrong, then that individual may need to be dismissed, but they will need to have signed a contract of employment. So we make sure all of these things are done before a company goes live to look to raise finance. Shareholder protections, making sure that if you're not going through us or you're going through anybody else, just make sure that there are adequate protections in terms of tag-along rights and drag-along rights, or tag-along rights for investors, and preemption rights on new fundraising or transfers. Again, all this information is in the guide. And lastly, just making sure there's share options for the non-key main members of staff. So Dermot said, people don't want to hear about tax. Oh gosh, they do want to hear about tax, because it's the EIS and the SEIS which largely drives this this market. So to be clear, this is the tax relief for the investor. So under EIS, if you're a high rate, if you're 40% or 45% taxpayer, the initial investment, you're going to get 30% back regardless of what taxpayer you are. If it goes bust, you get a further amount of tax relief. If it doesn't go bust, there's capital gains tax relief, inheritance tax relief, and various other things. Then you've got the seed enterprise investment scheme, which is the younger offspring or sibling, whereby you get much more. It's got to be an early stage company, their first round of funding, and the maximum they can raise in total is 150,000. For the investor, you can put in up to £100,000 per year. And again, there's lots of tax relief as well. So that's it from me. Dermot, I kept it and Renita, I kept it under 20 minutes. So I'll stop sharing and hand back or look at the Q&A chat.
Very good. Oliver, tremendous. Thank you very much indeed. So we've got a couple of quick questions on the line. So perhaps we could turn to those and then we'll have a chat more generally about the project, which I think for all of us is absolutely fascinating. So from Stefan Glaenzer, what are the results of the top decile investors?
They have made, I mean, we've got some investors. So the top 10% have made significant amounts running into millions. I don't know what the precise amount is, but there are people who've done phenomenally well out of this. And of the three, I gave 3 case studies. We've got someone who invested into 2 of those. So we can provide more information. Notwithstanding that, if you do get it right, it's a fantastic asset class.
Yeah, so while you were giving your excellent presentation, for which many thanks, I looked at the internal rate of return graph that you obviously offer with this, and the top 10% have all enjoyed a 20% or better IRR. So that's pretty good.
Yeah.
So there are various ways you can look at this differently and cut it. So I hope, Stefan, that answers your question. We have another question from, in fact, Paul Riley, who says, if you have 50K to invest, is it best to invest into one deal? And the deal you've got to have a great feeling about. I think that's quite an interesting indicator. But of course, you could also spread your risk and put it into a number of deals. Any comments?
Yeah, I mean, I think it's going to be fairly obvious. If you're just being a largely passive investor, I'd do 5 lots of £10,000 if I were you. If you've got one company you're going to put everything into, eggs into one basket portfolio theory, I'm sure most people know about that, then I think you'd have to be A, pretty sure, but B, ideally get a bit more involved into the company, whether it's acting as a non-exec or something like that. So you can get involved. Just on the word of non-execs, we do, and this is why it's good working with someone like Stakeholders, we highly encourage people to get involved and support where they can, not just interfering. It's got to be genuine support, and you can take non-exec fees. We tend to have a rule of thumb that any non-exec fees should be roughly 10% of what your investment is. So it's not quite fair to say, well, I'm going to invest £25,000 and take out 12 grand a year in non-exec fees. You can put in 100 grand and take out and ask for 12 grand, or take it in share options or growth shares, which is another potential option.
Yeah, growth shares is a very interesting option. I agree. Thank you for that. So there are now quite a lot of questions coming up on the screen, which is great. Keep them coming. Thank you. But one from Andrew Gall. Could you please post the link to the guide that you held up? We can do that afterwards. So yeah, that answers that one very quickly.
Just to say that there's a few, there's a final version going out next week. Okay. So we'll make sure that those who want it, we'll get that.
Okay. And then Peter Cowley, my data in the table. So Peter, thank you. You obviously took part, but you are identified anonymously, if you could ever be identified anonymously. So Ollie, have you calculated how many have reached cash on cash break even? Peter Kelly.
Very good, Peter. And again, thank you very much, Peter and Cambridge Angels and others have been very, very generous in their time. It's a good thing to work out. We will work that out and get that data. And thanks for your input and support. And if you can find anyone else to add to that, that would be great. And I'll drop you a line. But that's a very good point. We will work out who has managed to reach cash on cash break even level.
While we're going on, do you want to expand on how many of the investors actually are underwater in terms of their portfolio currently?
So there was 5 out of 43 are underwater at the moment.
Yeah.
And there are a lot of challenges with the data. It takes quite a lot of time to gather the data, and then you've got to work out or each individual investor has got to work out what their current portfolio is valued at. Also, as someone pointed out, actually it might be if you are underwater and have had not such a good result, you may be less inclined to complete the survey. But we've urged people that we know, and a lot of this is down to personal relationships, We wanted to have all the news, good and bad. So yeah, so that's that.
Very good indeed. And in fact, it does seem to slew the results, but it does also make it look like quite a safe haven for investing with some pretty spectacular results at the back end. I think definitely patience is important. You said it was valued over 10 years. So angel investors. And the other thing that I think that came out of my analysis of the figures was that the average portfolio size was 35 investments per investor, which is quite high, I would have said. Do you want to comment on that?
Yeah, well, we've got some people who I can mention by Peter and Rafe, who are very prolific. They've done nearly 100 investments each, and I dare say Peter's done a lot as well. So we have got some that have done, and they do this all the time. And you know, we get people saying, right, I'm not investing anymore, I'm full, I've done 50, and then they just sort of, you know, they're like moths around a flame, and they see something else wonderful come along and they invest too. So you know, it becomes great fun. I have to say, it's a great fun thing to do. The average net worth of our investors is around about 5 million, and this is their top 5 to 10% that they're looking to put into EIS early stage investing.
Very good. Coming back to the questions now online, of which there are a lot more and growing. By the way, Peter responded 76. I'm sure he wouldn't mind us sharing that. Adam Hale, so what is your advice on share class for angels? E.g., I passed on one recently, which gave angels very few voting rights.
Yes. So there is a whole section on different share types in the guide. Really, you want to have ordinary shares that are on model articles which have got fair voting rights. You sometimes you can get A ords, which normally gives people a little bit more preference, or B ords where they are non-voting or fewer voting. Quite right. I would. Why would you want to invest where you're getting fewer voting rights? And I have to say, this is where we are trying to, as we say, we're trying to educate both sides of the market, the entrepreneur and the investor, so we can get better deals done.
Very good. Well, thank you. Next question, if I might. Could you say something about the timing of exits? And again, I come back to the comment that you mentioned 10 years in this current piece of research, but back to you.
Yes. So, and there's another question about, can you qualify the most common type of exit? So yeah, first of all,
miss that. Yeah.
Yeah. So first of all, exits are probably on average something like 7 to 8 years. They're not 3 to 5 years. So I've been investing since 2004. So as a bit of background, I sold my business in 97. I made 3 investments, all of which went bust. And that's when I just thought there must be a better way of doing this. And so it's not 3 to 5 years, it's much longer. So the most common type of exit, personally and through the business and through research, it is through a trade sale. It's through acquisition. And we've just had, Go In Store, which has just been acquired. This is a fantastic, I'll talk about it openly. Go In Store, they did it was a CRM system. We thought it had gone bust about 2 years ago. And it's just been acquired for $140 million. And it's just been a phenomenal success. That did exit in about 5 years, but usually it is longer. And that is one of the downsides of this asset class. It's not particularly liquid, and it does take much longer. And we have asked people what the average is, what the average exit horizon is, and I think we're coming out roughly around about 7 years.
No, very good. There are a couple of sources of questions I'm reading from. Some are in the Q&A and some are in the chat. Doesn't matter, keep them coming. But if we just go back to the Q&A, Richard Fraser, can I ask, your sector-specific sectors, if you like, that you would suggest they avoid? That's a big one.
Yeah, I think that's a too big one. And I'm not, I can't think of any ones to avoid. I mean, I'm a generalist, like many people, we're generalist investors. I think the ones that we're seeing the most appealing and attractive ones at the moment are fintech, well-being, medtech, sort of marketplace, AI, those types of things. Although everyone's slapping AI over all their propositions at the moment, thinking that's going to make investors gurgle with delight. But there's nothing particular I can think about to avoid.
But I think most angel investors will stick to what they know. I think if you don't know that sector and you think it might be glamorous and it could be worth a punt, you have to.
Yes, it's very true. Also, it's a way that they explain things. So we had an investment called Cypher Surgical, which is a very elaborate medtech deal, which no one understood until the guy who was doing it said, well, what it really is that it's a windscreen wiper at the end of a laparoscope when you're doing keyhole surgery, which means that they can do 3 times as many keyhole surgeries in an hour than they would previously. And even though people knew nothing about medtech, it was very clear the problem and the solution and the route to market. And so we've got loads and loads of generous investors putting money into that because it's quite a simple problem and solution and execution.
So Colin Mason's just posted a link in the chat. Some of you might like to go to that. Very interesting. Adam Hales asked another question. There are so many questions coming in. And so what we might do is just finish off by answering those offline, but there might be time for 1 or 2 more. Certainly from our side, we are setting up a syndicate and we are looking at the whole subject of liquidity because we're getting quite a lot of questions about time to exit. And I don't know if you've got any comments on secondary markets, because that might be quite an interesting option to consider. It's certainly in our syndicate format and included in our charter.
We've got a whole paper on secondary markets. It's a very, very difficult nut to crack. It's massive need for investors to recycle their cash. They've got their 3 years under EIS or SEIS, and they want to sell. So secondaries, as opposed to primaries, which is raising new cash. I would love to see an efficient and effective secondary market, but there are too many challenges, which I can share or debate on another occasion. As I said, we've got a whole paper about it. And the main thing is that the companies don't want to have a secondary market, because there's no real benefit. There's not enough of a benefit for them to have a secondary market. We can talk all about that. Shall I just run through some of these quick questions and see if there's any? If I were to invest 5,000 in a company within your structure, how would you put it forward as an NED for any purposes to invest in? That's you can talk about the syndicate idea, which is great. Any ideas on what to do if you're asset-rich, income poor, hard to get EIS breaks? That's a good question.
So we've one of those going through at present, and
yeah,
clearly, if you're investing out of your SIP or SIR, you don't get EIS because you've obviously got it on the way in for your pension scheme.
Yes,
and clear. And all that happens is quite simply, you put your money in, but you don't get your EIS or SEIS certificate back, and that's as simple as that.
Yeah. We've had a number of companies who have had civil loans or various other things like that. Again, you have to be careful because any investment as an EIS or SEIS investment cannot be used to repay loans, which can be a bit of a problem.
David Stroud, interesting question. Those returns on data that you analysed, were the returns only after 10 years? In effect, I suspect the answer to that has to be yes, because of the balance sheet nature of the style of research that you've done.
Well, it was a snapshot. We've had people who invested over 10 years, and some people have had exits up to that time, but there are a lot most people had an ongoing portfolio, so we had to rely upon their current valuations, which was at their last valuation. And we know Colin Mason, obviously an academic up in Scotland, who's done a lot of work on this.
So Adam Hale has asked an interesting question. Do you know of any software for angels to track their investment and sweat equity? Obviously, he uses a spreadsheet inferred here, and he said, my spreadsheet is rickety.
Yes, we have looked into this, and we asked various angel investors, and most of which have their own fairly rickety Excel spreadsheet, and we haven't found anything that works efficiently enough for everybody. But that's a good, I mean, that's a good thing. It's jogged my mind to think we should revisit that. Actually, it's a good point.
Remember to connect with David Stroud, because he's just sent up a very interesting response. Everyone can see it on the chat line. Okay, very good. Well, so we've had a very interesting time together. Oliver, thank you so much. It's been terrific. Before we all go, there is our customary exit poll, because obviously we want to do more of these, but we must learn from you, the audience, about how you felt this has come across and the content, and whether or not indeed you'd like us to do more of these types of webinars. So it'd be really good to have your feedback. So I'm wondering if you could please go to the feedback form, which should now be showing, and tell me and tell us indeed, and this will be shared with Oliver, exactly how much you have rated this event. So the results are indeed still coming in, which is tremendous. Yeah, coming in. Anita, can you tell me when you think it's completed? Send me a message, that would be great. I think we're pretty well done.
Yeah, results are still coming in.
Okay, very good. Well done, thank you.
Some very, very good questions here, I have to say. I mean, you've clearly got a very informed audience. Dermot and Renita, well done.
The good thing is that this has been recorded, so everyone can have a recording of the event, and we will follow up on any questions that weren't answered.
We've got an interesting question here about angels who invest via a convertible bond. Are they more successful? A good question. Convertible bonds or convertible loan notes are not EIS-able. We're also seeing more advanced subscription agreements, which are EIS-able. So we're seeing a few different types of investment structure. Certainly ASAs, the advanced subscription agreements, have come over from the US, and there's a few people doing them like Sea Legals and others. But on the convertible loan notes, they tend not to be EIS-able.
Oh, very good. Renita, I think we're done, are we?
Yes, I've ended the poll. That's done.
Last chance to complete the feedback form before we close it. Thank you all very much indeed for your thoughts on this. Very useful indeed. And so Oliver, are there any other points that you'd like to make on today?
No, but other than I'm thrilled and delighted that people like you, Dermot and Renita, are putting these on. As I said, I feel I'm on an absolute crusade to better educate entrepreneurs and better educate investors to try and professionalize this slightly amateurish market so we can all get better deals done. So successful fundraisers and successful exits, that's what it's all about. And thank you for inviting me, Dermot and Renita.
Fine, there's a little supplementary I'd like to. So those online today, if they'd like to get involved, how best to get involved? Shall they contact you? Should they contact us? We can forward it, because you're asking for more surveys to be completed.
I will send it to you, Dermot. Yeah. And so because we've got quite a few channels, so it's better people manage their own
Okay.
channels.
So
to
that's
speak.
the way we'll do this for those online. Come to us and we'll get you the survey form for you to complete.
Absolutely.
Really good. And then final question, what's next? Because this is a great piece of work. So will you make this an annual event?
Well, what we wanted to do is to do the annual update. It was a lot of work getting the initial research, and it took up a lot of my personal time, which I'm very, very happy to do. But now I've done the initial heavy lifting, I'm hopefully going to do it as an annual index and improve it each year.
Yeah, that's terrific to learn. Really good. Well, everybody, thank you so much indeed for attending this afternoon's webinar. It's been really good to have you online. Oliver, thank you so much for sharing some really deep insights. You've got some great supporting documents, the 2 reports that you mentioned. We have also got, and you must use it when you go online with us, the key investment disclosure document, which is really important and it will help you. And there are some important evolutions on that coming up very shortly. So thank you all once again for joining us this afternoon. It's been a wonderful event. Just finally to say, au revoir and see you next time. Indeed, bye for now.